Welcome to Explain the Charts, where today we are conducting an in-depth analysis of the SPY, representing the S&P 500, on March 17, 2026. The market is currently reeling from geopolitical tensions in the Middle East as the Iran war shows no signs of slowing down. Yesterday, we saw a notable rally across the major indices as oil prices finally retreated from the psychological $100 per barrel barrier. Specifically, the S&P 500 closed up about 1%, finishing at 6,699 on the index, which reflects a price of roughly $669 for the SPY ETF. If we look at the daily chart, we can see that the market has just capped off a brutal 3-week losing streak. The recent price action suggests that investors are caught between the fear of a massive energy-driven inflation spike and the optimism of a tech-led AI relief rally. News reports indicate that the extreme fear zone is where the sentiment currently sits, despite the intraday surges we've witnessed. Goldman Sachs has warned that a severe oil shock could drag the index down to 5,400, which would be a massive reversal from our current standings. Conversely, some analysts are still eyeing the 8,000 mark for the index if the conflict resolves and the Fed remains accommodative. Looking at our first scene on the daily time frame, the long-term trend has clearly shifted from a bullish parabolic move into a wide, volatile range. We can see a series of lower highs forming since the peak in early February, indicating a potential topping pattern as suggested by technical analysts at MarketWatch. The volume has been consistently high during the red days, which suggests that institutional selling might be the dominant force whenever geopolitical headlines sour. However, the support at 661 has held remarkably well over the last few sessions, preventing a deeper slide toward the 600 level. This support zone is critical because a breach here would likely trigger a wave of algorithmic selling and margin calls. It is important to keep this daily structure in mind as we transition to shorter timeframes to identify potential entry points. Switching over to the 1-hour chart, let's zoom in on the specific range between March 12th and today to see the mechanics of the recent rebound. During the March 12th and 13th sessions, the SPY experienced a vicious pullback as oil prices hit their highest levels in years. We can see the candle at 11:47 Universal Time coordinated on March 12th, showing a sharp drop from 673 down to 670 in a single hour. This correlates perfectly with news of Iranian strikes on energy infrastructure, which sent shockwaves through the futures market. By the morning of March 13th, the price had dipped even lower, testing the 661 level multiple times during the session. Notice how the buyers stepped in aggressively at that 661.36 mark, creating a series of long lower wicks on the hourly candles. This V-shaped recovery into the close of the week was driven by reports that diplomatic channels might be reopening, cooling the energy market slightly. Monday, March 16th, showed a gap up in the pre-market as traders reacted to cooling oil prices and Nvidia's GTC event announcements. The hourly trend throughout Monday was a steady climb, reclaiming the 668 level, which had previously acted as a minor resistance point. Currently, the SPY is hovering around 669, and we are seeing the 1-hour candles consolidate as the market awaits the Fed meeting. The 1-hour timeframe highlights a relief bounce structure, but we must be cautious as the price has not yet made a higher high relative to early March. If the price fails to break above 672 on this timeframe, we might be looking at a dead cat bounce scenario before another leg down. Watch for the volume on these hourly candles. We want to see increasing volume on green candles to confirm that the bulls are actually in control. The RSI on the hourly is moving out of oversold territory, suggesting there is room for a bit more upside if the news cycle remains quiet. However, the constant threat of a supply disruption in the Strait of Hormuz makes every hourly move extremely sensitive to headlines. Traders should use the March 16th high as a local resistance target for short-term long positions. If we lose the 665 level on the hourly, it would invalidate this immediate bullish momentum and likely lead to a retest of the week's lows. The gap created between Friday's close and Monday's open often acts as a magnet for price in these volatile conditions. We have not yet filled that gap, which suggests that the momentum is currently skewed to the upside in the very short term. Let's look even closer at the 15-minute data to see the granularity of yesterday's rally. On the 15-minute chart, the rally on Monday, March 16th, is even more pronounced as we see the sequence of buying pressure. Look at the candle at 13:32 Universal Time Coordinated. We see a significant jump from 668.51 to 670.37 in just 15 minutes. This specific move aligns with headlines regarding President Trump's comments on the Iran war, which the market interpreted as a sign of potential de-escalation. The 15-minute chart shows a classic step-up pattern where the price consolidates for 45 minutes before making another leg higher. Resistance at 671 was briefly tested, but the price was rejected, leading to the current consolidation we see near 669. This granularity shows us that while the overall move was up, there is still significant hesitation near the $670 level. If you are a day trader, these 15-minute pivots at 668 and 671 are your primary boundaries for the upcoming sessions. The transaction count on these 15-minute candles was elevated during the afternoon rally, confirming high participation. We also see a death cross mentioned in financial news for some sectors, but on this intraday chart, the shorter-term moving averages are still pointing up. Notice the candle at 11:47 Universal Time Coordinated on March 16th, where a deep dip was immediately bought up, showing that the 664 level is a strong intraday support floor. This suggests that dip buyers are still active, looking for a safe harbor in big-cap tech stocks as the energy crisis fluctuates. Micron and Micron Technology's 5% rise mentioned in news is reflected in these smaller spikes throughout the morning. The 15-minute chart is currently showing a slight bearish divergence on the momentum indicators, which might hint at a pullback towards 667. Short-term traders should look for a successful retest of 667 to confirm if the Monday rally has staying power. If we lose 667 on this time frame, the probability of a full retracement of Monday's gains increases significantly. Returning to the daily chart to look at the big picture, we must weigh the bullish and bearish cases for the rest of 2026. The bullish case rests on the tech sector's resilience. Nvidia's CEO projecting $1 trillion in AI chip sales through 2027 is a massive fundamental tailwind. If the Fed signals a pause or a dovish tilt this week, the SPY could easily blast through 680 and aim for 700 again. The bearish case is rooted in energy triage and the historical pattern of oil spikes preceding a major recession. Many analysts point to the 0.7% GDP growth revision as a sign that the economy is cooling faster than the stock market wants to admit. Key price levels to watch. 661 is our major support floor. If this breaks, we are likely heading to 640 or even 620 very quickly. On the upside, 680 is the heavy resistance where a topping pattern seems to be completing. Reclaiming 680 would be a massive statement by the bulls and would suggest the correction is over. The probability of the SPY remaining range-bound between 660 and 680 for the next 2 weeks is quite high, perhaps 60%. This sideways action is expected while the market waits for more concrete news from the Middle East and the Federal Reserve's final decision. A breakout above 680 has a 25% likelihood if energy prices stay below $95 per barrel. A breakdown below 660 has a 15% likelihood, but this would jump to 40% if Brent crude spikes back above $105. Look for the Fear and Greed Index to move out of extreme fear as a secondary confirmation of a trend reversal. Also, keep an eye on the VIX. It is currently elevated at 26.49, which usually indicates that further sharp moves in either direction are coming. When deciding when to trade, watch for the 4-hour close relative to the 668 level for a signal of short-term direction. If we see a daily close above 672, that would be the first sign that the 3-week downtrend is finally being challenged. In the long term, the index remains 2.13% down year-to-date, which shows that we are still in a corrective phase. The death cross in financial stocks, mentioned in the news, is a warning that the broader market strength is being tested. However, the AI relief rally could still act as the engine that pulls us out of this rut if earnings remain strong. Monitor the dollar index as well, as its approach to the 100 level is a psychological milestone for global trade. To summarize, we are in a high volatility environment where news is driving the technicals more than usual. Watch support at 661, resistance at 680, and the $100 oil mark as your primary indicators. The S&P 500 is currently at a crossroads, and the next few days of Fed commentary will likely define the trend for the spring season. Don't get caught in the noise. Focus on the high-volume levels and wait for confirmation before entering heavy positions. Unbiasedly, I expect we see one more test of the 661 level before we can truly say the bottom is in. If that test holds, the move back to 690 becomes the dominant probability for April. If you are trading the SPY, be sure to use stop losses to protect your capital against sudden geopolitical headlines. It has been a fascinating start to 2026, and the charts are telling a story of intense conflict and high-tech hope. We will keep tracking these candles as they develop throughout this war-torn market environment. That concludes our in-depth look at the S&P 500 for today's session of Explain the Charts. This video is for educational purposes only and is not financial advice. Always conduct your own thorough research and consult with a professional before making any investment decisions.